Hi, I'm Peter Rose, founder of Longwood Currency Trading. 3 critical Forex trade entry rules. I'd like to chat with you a little bit about that today, as I've had a couple of people that email me on a regular basis have been asking me questions about, what simple crap can you tell us about trade entry? Okay, let's do that. It's a wonderful day out, as you can see from the sun streaming in through the windows. We're into May of 2023 in New Hampshire, United States, and it's been kind of a chilly, windy spring with a little bit of rain to really bring out the chill. So we're glad to see a nice, bright, sunny day today. It poured yesterday, and so the grass is wet, and that's why I'm not out walking around, because I would get soaked. That's a rule for recording videos, is don't walk around where you're going to get soaked. So in your trade entry, you're looking at something, you have all this information, right? And that's cluttering your view of what's important to know before you hit bid ask. It's really stupidly simple. And I'll give you the 3 critical Forex trade entry rules, and I'll try to discuss each one a little bit. So what I'm going to try to do, as I do in all my videos and training, is to present what's the problem or what's the issue, how do I go about making the what work, and then finally the when. When do I do that? Well, obviously we know that we're going to apply these rules at trade entry, but it's the rules that create whether the trade entry is made. So when you actually do them, I can't do that in a 15-minute video. So you have to understand that. I tell you what rules that I look at. I could kind of explain why they're important, but you're going to have to fill in the gaps between there. I hope you can do that. If you can't, send me an email. Maybe we can chat about it. No charge. I don't charge anybody for sending me emails, or even if you want to talk about something, I'd be certainly willing to do that and try to help you to avoid you having to take a course. If you have experience in trading, I can generally figure out what it is that your issue is and kind of either give you a reference to something to look at and read, or give you enough information that you can kind of figure things out for yourself. I've been quite happy to have been able to help quite a few folks that way. Sometimes if you don't have the experience, you're just getting started in trading, or you've been trading for a while, even with large lot size, but you run into something and you say, "God, geez, I don't understand it. Why is this happening?" You might need to do a course or some consulting or whatever with me, and we could chat about that in email. I'm not trying to sell you anything. I don't have time to work with 100 people a year. I'm not selling a $500 course so I get 15,000 people buying my course and I'm living off course proceeds. I don't do that. I have a course, and I'd be happy to chat with you about what that course covers. There's 5 modules in that course. But regardless of that, these videos try to give you at least the what and the how of the particular issue that we're discussing at that particular time. And today, it's the 3 critical Forex trade entry rules. So here's the 3 rules. I could write them down on a whiteboard, but I'm too busy sipping my coffee and enjoying the view out the window here of the breeze blowing through the trees. So the 3 critical Forex trade entry rules are: number 1, you got to have a reasonable profit target. If you're looking at the chart and you don't see a profit target, then there's no point in looking at anything else. So number 1, reasonable profit target. Number 2, your stop can't be close to structure. Number 3, you should have some strong price action in the trend bias. Let's go back over those. Reasonable profit target. What's a reasonable profit target? I don't know. That's part of learning how to trade, not simply answering a question. In my videos, I've said, for me, trading on a 5-minute chart, day trader, wanting to get in and be done with my work in a couple hours, my profit targets they have to be at least 20 or 30 pips away. I'm not looking for a 5 pip profit target. I'm not looking for a 50 pip profit target. I may get out after 5 pips. I may hold the trade and let it go for 50 pips. I don't know. But if there's not at least 20 or 30 pips of runway for me, then I'm not going to consider the trade. So you got to have a reasonable profit target. I don't know what currency pair you're trading. I don't know what the ATR of that currency pair is. 20 pips may be way, way, way too much, and it may be just a half an ATR for you. So all I can do is say it has to be reasonable, and that's the what of it. And the how of it is, well, reasonableness is up to your interpretation of what that needs to be. Now the stop close to a structure, that's a little different. I don't worry about things like this beyond a simple statement of I have a set stop that I go, it's a short stop. People complain at me about that. I don't really care. Because you don't know how to trade, you're going to trip off a short stop, and so therefore I'm stupid because the stop is too short. You do whatever you want to do. If you want to set your stop at 20 pips, that's great. You want to set it at 50 pips. And I took a course one time where the guy's stops were 50 to 150 pips away. Oh, that's great. You're trading a 10 lot, and you're 100 pips away. That's $2,000. So whatever you need to do. But the stop that you choose to set, whether that's a static set stop or whether you're moving that around according to whatever criteria you're going to use, be sure that that stop is not in close proximity to some order flow congestion. You know, the technicians would call that structure. Structure is different than order flow. Structure is a representation of the order flow. I don't look at the structure, I look at the order flow. But until you learn how to trade, if you don't really know how to trade, nobody's there to teach you how to trade, then you look at this structure stuff. And that's a pretty good indication as to whether you're going to run into what you would call an order flow congestion, right? And the reason that you don't want your stop close to that level is because price will get sucked down to that level if you're going long, right? And you go long and you've got a structure that's order congestion that's 10 pips below that price. There's a tremendous, almost a gravitational attraction of that congestion of past order activity that's going to pull that price down to test that low, and so your stop's going to get hit. If the level is, if the structure is far away from where you would set your stop, then the probability that order flow is going to attract that price when it's already gone a certain distance above there would not be as dangerous of a situation, and so you wouldn't need to worry about that so much. My process is very easy because I know exactly what my profit target needs to be for the win-to-loss ratio and the average win value that I have, as well as my per trade expectation value and my return against risk. I have those 4 metrics. I know those, so I know what a reasonable profit target for me should be. I don't worry about the entire aspect of risk management because I solve that up front at the entry. I don't have to worry about it during position management because my rules don't even account for it, because what their rules account for is making money, not preventing myself from losing money. So I don't want to trade in a complicated manner. I just want to make it really simple. So for me, a reasonable profit target, I can look at a chart, and I can look at a chart, and in 15 seconds, I know whether I've got something worth sitting down and managing because I'm ready to have an entry, or whether I want to set a limit and go brush my teeth or something. But if I don't see anything that looks reasonable, then I'm just not going to do anything. I'm going to check the market for when the number of bars on the time frame that I'm trading has gone enough to change the condition of price action and order flow structure such that it may be time for me to look whether there's another trade entry there or not. The only thing I can caution you about is when you're setting your stop, make sure that stop is not close to a congestion of order flow or structural point, because price will get sucked to that level and your stop will get hit. And that's not really indicative of having valid win-to-loss ratios, because if you're blindly not understanding where to set your stop, it's going to throw off your win-to-loss ratio, because you're going to be losing more times than you really should for the ability that you really have in trading, because you get your stop in the wrong place, or you judge that wrong. Wrong to me is not the distance that the stop is from entry, but the proximity of the stop to order flow. And the third, remember we've done reasonable profit target, stop close to structure, and now we're going to talk about strong price action. Guess what that would be? Is price moving strongly in the directional bias of price action? Do I have a trend? I might not have what you would call a trend. You know, truly trending prices only happen about 30% of the time when you're actually in a trend. That trend may go for a long time, but in the length of a month, you'll see those trends 30% of the time, because the trend gets broken. I mean, if you're on a 15-minute chart, it's going to go up. What's it going to go up on a 15-minute chart? It might go up a couple of hundred pips, but then it's going to have a retracement of some kind, right? So how you judge your trend bias, how you define what a trend is, and what time frame you're making these judgments based on, or if you're using multiple time frame analysis, how you're sizing the longer term chart price trend bias to what's going on in your shorter time frame. That's all part of understanding the trading process. So you see these guys out there talking about, oh, you've got a rising trend. Well, oh, really? What time frame are you talking about? What time frame are you judging that trend bias on? What time frame are you trading on based on concern for that trend bias? If you're trading on a 1-minute chart, does what's going on in a trend bias on the 4-hour chart have absolutely anything to do with what you're going to do down on the 1-minute chart? I don't think so. Does the trend bias on a 15-minute chart have anything to do if you're with what your trading is doing if you're trading up on the daily chart? It absolutely does not. So you really have to understand the process of trading instead of just these words of wisdom, or you're going to get yourself jammed up. But the third rule is be sure you've got strong price action in the direction that your profit target is in. So if you got a long profit target, you got to make sure that you got strong long price action. If you have a short profit target, then you got to make sure that your trend bias is down, so that the price, what I call and what I've termed in my videos and in my courses, the price momentum. It has the momentum in order for it to get to that profit target before there's a retracement and it goes and hits an exit point that you may set. So 3 critical Forex trade entry rules. Number 1, that have a reasonable profit target. Number 2, make sure your stop isn't too close to some kind of structure. And number 3, make sure you've got strong price action in the directional bias of where your profit target rests. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.